Welcome to another edition of Stock Talk, formerly known as Sector Spotlight. I'm Alec Richards. I work on the energy team, and I'm joined in the studio by Energy Sector Head Kevin Kaiser. If you have any questions, please submit them in the comments section below the video player, and we'll hit them after Kevin's presentation in Q&A. And with that, Kais, take it away.
All right, thanks, Al. We're going to go through the gas compression rental industry today. So really only 4 publicly traded companies. Small to mid-cap companies, Archrock and USA Compression, and then CSI Compresco or MLPs, and then Natural Gas Services Group is a small cap C Corp. So that's the industry. It's a small niche industry, sort of sits between oilfield services and midstream. And we're going to walk through some of the industry dynamics, some of the trends, and then what we think of some of the different companies in this deck here. So we'll start on slide 3, just the key takeaways. Point 1 here is the industry structure and the dynamics today are relatively weak. It is a cyclical industry, but we think that the current downturn is more than just cyclical issues. We think that the industry has some structural issues as well, which we'll get into. Point 2 here is that on a relative basis, we think Natural Gas Services, the C Corp, is the best of the 4 companies for a few different reasons. Its end market, like the rest of the business, is challenged. It's probably actually most challenged, just given its position in the lower horsepower segment of this market. But there's some other reasons that we like NGS relative to the peers. The biggest reason for that is probably its balance sheet. The company has no debt and actually net cash of around $5 or $6 a share. We'd be interested in being long NGS closer to book value, which is $17 a share. So we think it's a little bit expensive to fairly price today, but would be interested closer to 17 or 20 bucks. On the other 3 companies, we kind of look at them as below average businesses trading at average prices. So not interested in Archrock, USA Compression, or CCLP on the long side, and not on the short side either at this point. Just at this point in the cycle, the valuations look fair, nothing crazy. So we don't think they make for great short candidates at this point either. Moving on to slide 4, some key takeaways on the industry. So like we said, the 4 publicly traded companies, that's kind of it. They have about something like 50% of the market share, maybe a little bit more. So the industry is quite consolidated at the top, with 4 or 5 companies controlling 70%, 75% market share, but then there's something like 100 small private companies that have about 25% market share. The industry is highly competitive, fragmented, particularly at the lower end on the compression side. It's capital intensive, cyclical, and commodity price sensitive. When we look at ROICs and return on equity across the different companies across the cycle, tend to be in the low single digits, and we're only on average 8% at the prior cycle peak in 2014. So relatively weak returns on capital. One interesting thing that we learned going through this research process was that the MLP structure has really wreaked havoc on this sector, this sort of oilfield services subsector. And sort of what's happened is, previously companies were trying to earn a return based on EBIT or a return based on net income. And with the proliferation of EBITDA, adjusted EBITDA, and distributable cash flow, these MLP-like metrics, companies have basically lowered their price hurdles in order to earn a return based on EBITDA instead of EBIT, or distributable cash flow based on net income. So the MLP structure just in general has put some pricing pressure on the industry, which obviously is a negative. Leverage, the companies are highly levered, particularly the MLPs. So APLP, USAC, and CCLP are all over 5 times levered. And then the industry has gone through some pain in this current down cycle. APLP and CCLP have already cut distributions. USAC, I think would be a candidate for a distribution cut in the future. Some points on NGS here in the middle of the slide. So we say NGS is a lone bright spot. So some of the reasons why we like NGS. They have the Southwest Airlines business model, so they build all their own compressors. They build these to the same specs, which allows for easier maintenance, less downtime, and cheaper maintenance. So they tend to charge their customers a premium because they offer better service, so a 5 to 10% premium compared to their competitors. And then they also have better maintenance stats. Point 2 here is conservative accounting and financial reporting. So they, unlike the MLPs, they actually expense 100% of the costs of maintenance and refurbishment on the existing compressor. So if you look at their cash flow statement, you'll see very low capital expenditures over the last 6 to 8 quarters. All the dollars that this company spends on existing equipment is run through the income statement, which we think is very conservative. We mentioned this before, but the balance sheet, so $6 a share in cash, no debt. The company doesn't pay a dividend right now. Strong cash flow generation even in the down cycle. So NGS generated real free cash flow of around $2.50 a share in 2016 and 78 cents a share just in the first quarter of this year. And point 5 here is that mired in the down cycle, the fleet is only 50% utilized. So we do think that the company has some leverage to higher commodity prices, particularly on the oil side. About 50% of NGS's fleet is used for gas lift and oil wells, and they have a strong position in the Permian. Point 6 here, current price 25. We talked about this. We think it's fairly priced. We'd be interested more interested under $20 a share. Tangible book value is $17 a share. Should lend some downside support. We like the CEO a lot. We don't say that about many energy CEOs, but we really like Steve Taylor. Thought he's very forthright and very realistic, and not promotional at all, which we appreciate. And again, wouldn't touch APLP, USAC, or CCLP. On slide 5 is a company comp sheet, just some of the simple capital structure, operating stats, and then some key metrics. We highlight some of these in light blue boxes here, so you can see how underutilized NGS's fleet is relative to companies with larger horsepower. So we do think that NGS has a little bit more kick in an eventual recovery. We also highlight the leverage. So again, NGS in a net cash position, its competitors very highly levered. Returns pretty low across the board, pretty unimpressive across the board. I mean, this is based on 2016, and it was definitely a down year for the cyclical industry. And then the last metric here, just one of the valuation metrics that we think is most instructive, is basically a price to, or an enterprise value to replacement cost. So this is enterprise value to operating horsepower. NGS, CCLP, and APLP all trading around $700 per HP. USAC trading around $1,000 per HP, and that's likely due to some dividend support still there at USAC. But just for reference, the standard the cost to build new compression is around $1,000 per horsepower, a little bit lower for some larger horsepower units like 600 horsepower and above, and a little bit less than $1,000 per horsepower for smaller units. So you're looking at something like $1,200 per horsepower for a smaller unit, $800 per horsepower for a larger unit, call it $1,000 on average. These assets, the companies for assets base are relatively older. For example, Archrock's asset base, I believe their weighted average life of their equipment is 13 years. NGS's is about half that at 7, so that's another important thing to keep in mind when thinking about valuation. But we do think NGS screens, is on this measure at least, is relatively fairly valued to cheap. Turning to slide 6. We talked a little bit about this, but here's the market share. So again, you can see this is U.S. market share by total horsepower. Archrock, USAC, CCLP are the big public players. Energy Transfer Partners has a large compression rental business inside of it, but it's just such a small piece of that business that it's not, they don't really emphasize it. And then there's that other piece where it's, something like 20% of the market is very small private companies. Slide 7 is a little bit where these companies fit in the compression food chain. So companies like NGS, CCLP, Flowgistics are in the smaller horsepower range. These are compression units that are used closer to the wellhead. Companies like USA Compression, Archrock, they have some higher horsepower units, in the 600 plus HP, which are used for central gathering facilities, and then wellhead compressors for more pad drilling. So 4 wells hooked up to one compressor, that would be higher horsepower application. And then on the long haul natural gas side, like a compressor unit on a long haul natural gas pipe, those are purchased by the pipeline companies like a Transco or a Tennessee Gas. Those aren't rented, so those are purchased and built into rate base. On slide 8, some of our field work. So these are some notes just from our conversations with industry experts, industry participants. Some of the key, I'm not going to read everything here, but some of the key learnings that we went through in talking to some of these people. This is really a service business. Reliability in service is key to profitability. I mean, if you think about what this business really is, what it comes down to is sending a maintenance employee in a truck to every compressor every 45 days. And so key to profitability is keeping maintenance costs in check, keeping the compressors running, and then high serviceability equals premium pricing. And so it is very much a service and labor intensive business. Some other things that we learned here, we already talked about how the MLP structure has wreaked havoc on the industry. Some comments on some of the individual companies. Archrock is known as the Walmart of compression. They tend to be everything to everyone. I guess our takeaway on Archrock from some of the conversations that we had was that even though they're the biggest player, that they have, of the large players in the industry, they have the worst customer service. In terms of current trends in the market, so the market for larger horsepower units right now is quite tight, particularly in the 700 horsepower range. There's definitely a shortage of Caterpillar engines in that segment, but there's a lot of availability in the 140 to 145 horsepower range. Let's see here, some other things. Even though oil prices have dropped recently, projects signed, so this is projects signed over the last 6 months are still going to go forward. We may see another slowdown, but the next 6 months should be pretty good. That's probably indicative of overall activity for U.S. onshore plays. Usually there's quite a lag in terms of activity in capital deployment decisions relative to oil prices. And then the last quote here is, the last thing this industry needs is a double dip. Many compression and oil field services companies are still on their knees. Another downturn would be extremely painful. Slide 9, some key industry trends for the compression industry. So low oil prices, reduced economic incentive for E&Ps to use gas lift, activity shift to liquids-rich shale, increased demand for gas lift and VRUs, vapor recovery units, associated gas to the Permian taking market share from pure gas wells. That's a positive for the gas lift and gas compression industry. Increased production per well. That is going to drive demand for higher horsepower units and push out demand for lower horsepower units. So that's really a positive for USAC and Archrock, and a negative for companies at the smaller end of the compression chain, NGS and CCLP. And then pad drilling, similar trends to increase production per well. And so definitely higher trends benefit at this point the higher horsepower providers. And you can already see that reflected in the company's utilization statistics today. On slide 10, just showing the trend of bigger wells. I mean, everybody talks about this. It's very real. This is an average Permian well, daily gas production by year of completion method. So you can see consistent performance driven by longer laterals, higher sand loadings, tighter frac spacing, et cetera, et cetera. So definitely the trend is in the direction of bigger wells. On slide 11, just a little bit in terms of natural gas gathering growth. So just overall natural gas production growth should drive increased demand for gas compression in the field. And so we should see something like mid-single digit growth in natural gas compression needs in the field in 2017, 18, and 19, and then a slowdown to 1% to 2% growth past 2020. On slide 12, the title is another uneconomic energy sector, and so this was the slide we alluded to earlier when we were talking about the returns that this sector generates. So it is a cyclical sector, but even in the prior upcycle, 2012, 13, 2014, for an upcycle in a cyclical business, you would expect returns to be better than 8 to 10% on average. And so we think that this sector has difficulty earning their cost of capital, which is one of the reasons why we don't think that there are that many compelling long ideas at the current prices. Slide 13, just a little bit in terms of comparing these companies relative to each other on a couple key statistics, utilization and gross profit per month per horsepower. So NGS is in the black bars there. You can see their utilization has fallen off the most because they have the lowest average horsepower, and that segment of the compression industry has gotten hit the hardest so far. And then in terms of gross profit per month, we see even despite the utilization rollover at NGS, it's still been able to maintain premium gross profit over its peers. Slide 14, last slide here, just NGS finishing up on the valuation. Again, we think it's fairly priced around the current price, $24, $25. We'd be interested in getting along the stock below 20. We think $17 per share, that's tangible book value, provides some downside support. So there's our free cash flow forecast in our valuation analysis. And then that second table there is just a table of recent deals in the space and putting them on a dollar per horsepower basis. On average, $953 per horsepower, again, which is about replacement cost. And again, NGS and some of these other companies do trade below that metric. So to the extent we see some more consolidation in the space, that could be an upside surprise for a company like NGS or some of the other players. With that, I'll wrap it up and turn it over to Alec for some questions.
Yeah, awesome. So we're going to start here. We got rapid fire. I'm just going to read off a question, and we got a pretty cool graphic there. I'm going to read off some questions.
One word answer?
You can make it a little bit longer, but we want it quick.
Okay, I'll go try to do one word.
One word?
I'll try.
Oh man. Who is the worst management team in your space?
In the entire space or compression?
I don't think compression, probably the wider universe. Let's not pick on compression.
Okay, worst management, that is really hard. I think there's a lot of bad ones. I'll say, I can't. For now, I'll say SEM Group. I mean, there's a lot of bad ones. I'll just say SEM Group because they made a really poor decision with financing a recent acquisition, so SEM Group.
Okay, that leads into the next one. How much equity does SEM Group need to get its balance sheet in proper shape?
$1 billion.
Wow, that was quick. What is the most important macro driver in your process?
In my process?
Yeah.
Macro driver. Oil price.
Yeah. How long does it take for you to develop a best idea?
4 to 8 weeks.
4 to 8 weeks. All right. Is TEP, TEGP, that's tall grass, still short?
Yes.
Yes. That's quick. You're good now. Who is the most aggressive non-GAAP financials in your space?
Genesis Energy LP.
All right. What's the best looking subsector in energy, not the best looking analyst on the energy team?
Best looking subsector?
Yeah. We can do a pass too.
Let's say Marcellus gas producers.
Wow, all right, I didn't expect that one. Cowboy boots or dress shoes, which would you prefer?
Cowboy boots.
Yeah. Fishing or research?
Fishing.
Okay. What's your favorite short?
Favorite short? Tall grass.
And
TEP.
your favorite long? I think that's pretty easy because you only have one.
Yeah, Royal Vopak,
All
VPK.
right. All right, you're off the hot seat. We're going to go to regular questions now. All right, let's go to an accounting question first, so you can educate some folks here. It starts off, accounting question, useful life of equipment for depreciation expense. I'm guessing, how do they determine the useful life, or maybe how that's used in some of the things that you've talked about in the past, like maintenance CapEx?
Is this specific to the compression
I don't think
industry,
it's specific to compression. My guess is it's more broad-based.
Let's make it specific to compression, just
Okay.
because I think the the useful life used in the compression industry is around 15 to 20 years.
Right.
So, yeah, whatever the capital cost of the equipment is, they're going to amortize that cost over a 15 or 20 year life, and that's your depreciation charge.
Right.
So yeah, 15 to 20 years is pretty standard. I think anything over 20 years is going to be pretty aggressive and pushing it.
Right. Yeah. All right. You've been a notorious bear on the MLP space. Is there any names that are compelling to you now on the long side? And if not, I think this is a more general question at the end here. If not, at what price would something that you might think has a strategic benefit or a good management team, at what price would that become attractive to you? Or maybe at an oil price, maybe
Sure.
that's the best way to peg it.
Yeah, I don't have any current longs in the MLP space. I don't think there's really any reason why any of these businesses should trade at like a premium to the market. Mm-hmm. So I think if some, high quality MLPs without a general partner, without 5 to 6 times leverage, traded between 15 and 18 times earnings, like I think that's probably a fair price for a business like that, and that's something that I would be interested in. Okay. But as far as I know, there's nothing that kind of meets that criteria out there today. So that's what I would think. I mean, people don't like to value these businesses based on net income or earnings. I think it's a totally fair and appropriate measure of profitability for these businesses. So if Enterprise Products or Magellan or something like that got into that level, I'd be interested in the long side, but they're not there.
Yeah. Okay. So specific question just on E&P behavior here, and kind of the fallout from that. If wells are getting bigger, is there a frac or sand company you might like?
Maybe on the frac side, we haven't done a ton of work on the OFS and the completion companies. On the sand side, no. I mean, we spent some time earlier this year on some of the sand companies, right. And we came to the basically same conclusion as what's been pounding these stocks over the past 2 months, is that there's just very low barriers to entry. Really, the only barrier to entry is high capital costs. Right. And with these names all trading at significant multiples of replacement value, the stocks didn't make any sense on the long side. So the only way I'd be convinced to buy a sand miner would be if it was trading like well below replacement cost with very little or no debt. Yep. Because other than that, it's just like a tail of the whip, super cyclical play, and we're not going to make a call on oil prices through sand companies. Mm-hmm. And so, yeah, we're not interested in sand right now. On the frac side, I don't know, Halliburton, Schlumberger, but we don't have a call on those names.
Right. So one of the one long that we alluded to earlier was downgraded recently. Are you worried about the downgrade? Is it something that you think they're missing on the name?
No, not worried about the down. I think, a lot of the downgrade looked to be like sort of this play into 2Q earnings. For me on Vopak, it's not really a quarterly earnings story. I think the earnings will be fine. Like the business it's a very diversified business. They're the largest terminal operator in the world. They own terminals in 60 different countries. There's not one terminal that's going to make a great quarter or make for an awful quarter. It's a pretty stable business. But no, the downgrade was focused on into the quarter, and then also some longer term concerns over the demand for fuel oil tankage, given some changes in some sulfur regulations for the shipping industry. And the jury's still out a little bit about the impact of the IMO sulfur regulations in 2020 on fuel oil tankage. But I think it's actually going to be a positive for the really large players in the fuel oil storage and terminaling business, and that's definitely Vopak, just because there's going to be huge increase in demand for blending. Right. So that's going to be a positive for them. And then if you look at, the company that we do know very well, Sem Group, they just bought they bought the largest fuel oil terminal in the United States, about a month ago, and they paid, on a dollar per barrel basis or price to EBITDA, they paid twice the multiples that Vopak is trading at. And their view is similar, that the sulfur regulations coming in 2020 is actually going to be a positive for large flexible fuel oil terminals. So at least, we don't think that fuel oil issue is something to be really concerned about with VOPEC.
Okay.
Yeah.
It seems like there's no consensus on where oil prices are headed. I mean, I think, in my screen this morning, I think there was 3 or 4 articles. 2 said oil was going to 60, 2 said oil was going to 40. So there's not real consensus. But let's say, assuming oil is set for recovery, what subsector would be best positioned to outperform?
Outperform. I mean, a lot of sectors would do well. I mean, highly levered E&P companies. You mentioned sand. Probably sand would do well. Oil sands companies, so a little bit higher on the cost curve. Oil sands companies would do well. Probably those 3.
Yeah. Okay.
Yeah.
What's your highest conviction call right now? And maybe give the top 3 bullet points on it.
Yeah, I'd say it's still tall grass on the short side. Point 1 is that the company's core crude oil asset, Pony Express, is over-earning and has contracts expiring in 2019 and 2020. Point 2, the core gas asset in the company, Rockies Express, is over-earning and has contract expiring in 2019. And point 3 is we think the distributions at the LP and GP are unsustainable. And never mind the company's growth rate, but we don't think that the company will be able to. We think the company's going to have to cut distributions or merge the LP and GP. Circa 2018, 2019. Before these issues come into play. So, yeah, that's still the highest conviction idea.
Okay, we have time for one more today. We're going to end it with a geopolitical question and OPEC related. What are your thoughts on the recent OPEC headlines? Do these expectations play a role in your forecasting?
We'll have to get Joe McMoneagle on for a macro show to talk about that one, because now I don't. It doesn't. I don't do much more than read Joe's work and talk to him about it, but it doesn't really, play a huge role in the company-specific work that we do.
Right.
Yeah.
All right, everyone, thanks for joining us. We'll be back for another Stock Talk next Tuesday at 2:30. Have a great rest of your day.